In this video, I will be talking about a mean reversion RSI trading strategy. I will be talking about quality of trades versus quantity of trades. I will be showing how stops and targets can make a big difference in terms of profitability. And because this is a mean reversion strategy, I'm going to talk about overnight risk and weekend risk. This is Mark from TradeInform.com, and this is the second part of a two-part video series on the RSI Mean Reversion Trading Strategy. Now, the first part of this video is available on YouTube, and there is a link on the screen and below this video if you would like to check that video out. In the first video, I introduced this strategy, and I'm going to go over briefly again the strategy. Now, this is a short-term RSI strategy, and if you can see the chart on the screen at the moment, I'm looking at the RSI of values of 2 and 4 periods. Now, apart from the short number of periods, this is a standard RSI, and this video and the previous video are inspired by the works of Larry Connors. And as I said before, Larry has a new book out, and that book is called Buy the Fear, Sell the Greed. There is a link below if you would like to check out the excellent work of Larry Connors. Now, I've done my own work inspired by Larry, and I have come up with this RSI strategy. Now, I'm using the historical data, the daily time frame, the SPY Spider ETF. The first thing I want to do is look at the effects of stops and profit targets, which make a big difference to the trading strategy. One thing I mentioned in the previous video is that all of us traders must trade trading strategies that are not only profitable, have a quantifiable edge, have some logic to them, but we need to also trade strategies that suit our personality. And the thing about mean reversion trading strategies in particular is a high percentage of winning trades. You can see this particular scenario I've got here has got a 71% percentage winning trades. If you are the sort of person who wants to have regular but relatively small wins in your trading account, this is the type of strategy that you should be looking at. No point, if you want to have regular wins, there's no point doing a trend following strategy that might take 6 months to play out. You need to have regular short wins. You should be looking at mean reversion. So, okay, with the setup I've got here, first of all, let's have a look at how the profit target and the stop loss are going to affect this strategy. Now, firstly, you will see that I've set a wide and large stop loss here. This is an ultimate backstop type stop loss, very large, very wide away from the market stop loss. And I could equally just set this to 100, and it's not going to make a big difference because the losing positions are being closed in different ways, in particular with our time close here of 10 days. So I'm going to move that back to 10. And then I'm going to try 5, and you're going to see how profitability for this trading strategy is affected. Well, 5 times the ATR is still a pretty wide trading strategy for one that's not open very long. If I'm going to set this to 3, 2 times the ATR, and you can see what we're doing is we're eating into our percentage of winning trades, but we are still, in all fairness, retaining a fairly smooth capital graph over time. Now, if I wanted to change the other variable, let's move the profit target way out. We can get it to 20, and it probably is not being hit at all with this particular setup. And we can see now what we're getting. Again, we've got to be thinking as traders, largest winning trade, largest losing trade over time. We've got a ratio here of 10 to 1. If that's the sort of ratio that makes you smile, makes you feel happy, this is the sort of trading strategy you need to be looking at. But our average winning trade, not much higher, but certainly higher than our average losing trade. And we still retain a percentage winning trade of well above 50%. Now, if I'm going to bring this profit target in here, you can see we're going to probably increase our percentage winning trades at the expense of our net profit. So I'm going to push these both out to values of 10. Now, even with this type of strategy, there's lots of people who like trailing stops. This is a chandelier type trailing stop, trails behind the price, it's moved every day, and you can see we're going to get a different value again. And we can see the effect of this much more clearly if I extend this out to 50 days. And we're going to let the trades do what we will. And you can see we're getting quite a different type of strategy. We're getting a higher losing trade compared to our winning trade on average. We're getting a much larger losing trade. So you need to be the type of trader that can cope with that. But on the other hand, we're getting a lot of winning trades. We're getting nearly 80% of winning trades. And you can see how psychologically this is going to appeal to some traders and not to others. Now if I want to tighten the trailing stop, you can see again we're getting a slightly different feel. Lower profit, but a slightly different feel. Our drawdown has remained low. Over time, in this particular scenario, the annual growth rate is actually very similar to the annual growth rate of the underlying market, but with a small fraction of the drawdown, only 10% compared to 55%. Okay, so I'm going to take this scenario and I'm going to have a look at some different things. One of these is we've got all sorts of things we can change. If we have a look at the chart again, we can see how we are entering when the RSI dips below. Now I've set this model up to test what would happen if we waited until the RSI rises back above that line. And you can see here, just by clicking here, we can change the strategy. In general, in this scenario, it doesn't perform quite as well, but it still performs pretty reasonable. And it does give us a slightly higher percentage winning trades once again. Now, another factor we can change, and this is one of the things that I said we would look at, is quantity versus quality. Now we can, when I mean quantity versus quality, is how strict do we want to be? How many trades do we want to achieve our profit aims? So one way we can affect this is we can increase the RSI number of periods. So it would take a stronger downturn to get to our entry level. So we're getting fewer trades by doing that. The next thing we can do is we can change our RSI entry. So we're being stricter here, and as a consequence, we're not having as many trades. Smaller number of trades, but a generally higher winning percentage. There is no right answer to the question of quantity versus quality. For every trading strategy, there is going to be a trade-off between the most number of trades that we can get to increase our profitability and also to increase the number of times our edge is working in the market, so we can, statistically speaking, use our edge as much as possible compared to making sure we take the highest quality of trades. And this is a personal preference. If you're the sort of person that can be patient to wait and stalk your trades, then it is a good idea to go for quality. If you want to be in the market as much as possible, you are going to inevitably look at a trading strategy that has a higher number of trades. Okay, the next thing I want to look at is overnight risk. Now this is an important factor for anybody using mean reversion type strategies. The fear of taking a position at just as the markets are closing, wondering what is going to happen the next day. So I have built in a test in this model that we can have a look at here, and this is basically saying trade the next day open. So instead of taking the trade when the signal is made, in other words when the RSI has given us an entry signal at the close, we actually wait until the next morning and then we take the trade. So if I click on this, we can see that the trading strategy in this scenario, again, it works pretty well. So just by waiting to the next day, we can see it's not, in this case, given us quite the same level of profitability, but it's still giving us a pretty decent return over time. Now, the next thing we might want to know is if you've waited till the next morning and the market opens lower, there's fear in the market, so the chances are we're going to have theoretically a good trade. Can we have a look at that, quantify that information? What would happen if we trade when the price opens lower? It opens lower than the previous close. There's fear in the market, but we can test that just by clicking on this. And we can see that we're getting much fewer trades again. We're getting a smaller number of trades, but we're getting a good quality of trades. Smaller net profit, but our profit factor, our ratio of gross winning trades to gross losing trades, is higher. We're maintaining a good percentage of winning trades. Okay, so what would happen if we wanted to trade when we hit a low on a Friday? We've all been there. The market's selling off into Friday. Bloomberg and all the news channels are talking about what's going to happen over the weekend. Do we take the trade? So we can see here that generally speaking, yes, take that trade. Trade on a Friday low. So when we're hitting a low that happens to coincide with a Friday, we're getting a pretty decent level of winning trades. We can see one trade in particular, that is in 2015, where it was not a good idea, but on the whole, this matches up pretty well with our trading strategy. Good profit factor, good net profit. So weekend risk, it is a factor, but only once in a short while. So I hope this video has given you some ideas. It has given you some hard data. This is a trading strategy that you can use straight away. If you want to learn more about how I have tested this strategy, you can actually purchase this model in the Trade Informed shop, and there is a link on the screen to find out more about that. And if you enjoyed this video, please hit the like button. If you would like to see more videos like this about backtesting the market, about helping you to achieve your trading goals, please subscribe to this channel. And for more information, in particular about using Excel to analyze and backtest financial markets, go to www.tradeinformed.com.